VT and VTI are two very popular index funds from Vanguard. Here we'll dive into their differences, similarities, performance, and why you might want one over the other. Hey guys, John Williamson here, OptimizePortfolio.com, investing and personal finance. First and foremost, understand that even though their tickers only differ by a single letter, VT and VTI are two completely different funds, and one should not be considered a replacement for the other. Let's talk about index funds in general for a second. Why would you want to buy either of these funds? If you've landed here, you probably already know that stocks are a significant driver of portfolio returns, and that index funds are a great low-cost way to get immediate broad diversification across all sectors of the stock market. You also probably already know that Vanguard has some of the lowest fees around and has a solid track record of providing ETFs that accurately track their indexes. VT is the Vanguard Total World Stock ETF. As the name suggests, it's a market cap weighted fund that holds the global stock market. Specifically, VT seeks to track the FTSE Global All Cap Index. Its mutual fund equivalent is VTWAX or VTWAX. It holds everything in the world, all sectors, all styles, all cap sizes, and all geographies, except frontier markets. It's the broadest index out there. If you want to be 100% stocks, and you don't want to bother betting on specific countries or cap sizes or styles or whatever, just buy this fund and call it a day. And you can brag to your friends that you own over 8,500 stocks in your portfolio. Come back 30 years later and enjoy your gains. Doesn't get much simpler. VTI, on the other hand, is the Vanguard Total Stock Market ETF. Its mutual fund equivalent is VTSAX or VTSAX. I'm not sure why Vanguard doesn't include US in the name, because at a glance you might reasonably think the name of this fund implies that it is the total global stock market. It's not. This is just the total US stock market. Like VT, it's market cap weighted. Specifically, the fund seeks to track the crisp US total market index. So we're talking about all sectors, styles, and cap sizes, but only within the US. There are no international stocks in VTI. So while the fund still holds nearly 4,000 stocks, it is much more concentrated than VT, as VT holds the US plus all other countries in the world. As such, VT can be considered much more diversified than VTI. So now you can see why I said one of these funds should not be considered a replacement for the other. One is the global stock market. One is just the US stock market. The former includes the latter. Specifically, the US comprises about 55% of the global stock market at its global market weight. So these are two very different funds, obviously. What this two-fund comparison per se is ignoring is the fact that the investor wanting to be globally diversified who holds VTI will almost certainly also be pairing it with VXUS, the Vanguard Total International Stock ETF. That is, VTI plus VXUS roughly equals VT. Someone using VTI and VXUS together likely wants to dial in their allocation to US and international stocks, while the investor using VT just accepts the global market cap weights. Specifically, most investors doing the former are likely wanting to bet on the US by overweighting it relative to the rest of the global market. For a US investor doing this, this is called home country bias. But this comparison isn't about VXUS. Back to the topic at hand. Now let's look at the performance of VT versus VTI, which is usually the reason people choose one over the other. Here's the global stock market, which is VT, versus the US stock market, which is VTI, from 1986 through June 2021. So we should obviously pick VTI then, right? Not so fast. In the next section, we'll talk about why this isn't such a simple decision. So again, a decision between these two funds comes down to betting entirely on the US with VTI, or getting global diversification with markets outside the US with VT. Yes, the US has been the king of the global stock market. That's why its market cap weight inside VT is a whopping 55%, drastically outweighing every other country in the global market. Does that mean it will always be that way? Of course not. In that sense, the VT investor is more agnostic toward global markets and the performance of different countries relative to each other. It may seem intuitive and sensible to bet entirely on the US and go 100% VTI. Again, the US is a powerhouse in the global market. On the whole, its stocks have outperformed the broader global market historically. Why wouldn't that continue? Let's bet on the winning horse. Well, it's not that simple. Here are some sobering facts that will hopefully open your eyes to international diversification beyond US borders. First, realize that stock market returns are not correlated with economic performance. Yes, you heard that right. I'll say it again. Economic output is not correlated with stock market performance. The historical correlation between GDP and stock market returns has been roughly zero. The economy is not the stock market, and the stock market is not the economy. Presidents famously like to point to a rising stock market as an indicator of a good economy. They're wrong. Pundits on media outlets speculate on monthly, weekly, and even daily market movement as a result of economic activity. They're wrong too. The stock market simply illustrates the expectations of investors about the futures of publicly traded companies. Period. Here are a few examples to explain. The US economy was in the toilet in 2020, but the S&P 500 index, considered a sufficient proxy for the US stock market, returned a positive 12% for the year. Historically, the stock market of South Africa has outpaced the US stock market. It should strike you as obvious that one shouldn't only invest in South African stocks, even if you live in South Africa. Going broader, emerging markets stocks have crushed US stocks historically. Let's put some numbers to this idea of global diversification. Again, at global market cap weights, US stocks only comprise about half of the global market. International stocks don't move in perfect lockstep with US stocks, offering a diversification benefit. This is the whole point of diversification in the first place. If US stocks are declining, international stocks may be doing well, and vice versa. No single country consistently outperforms all the others in the world. If one did, that outperformance would also lead to relative overvaluation and a subsequent reversal. The legendary Meb Faber found that if you look at the past 70 years, the US stock market has outperformed foreign stocks by 1% per year. But all of that outperformance has come after 2009. But US companies do business overseas, people exclaim. I've always found that argument pretty silly. Excluding stocks outside the US means you're missing out on leading companies that just happen to be based elsewhere. Similarly, there have been periods where a global portfolio outperformed a US portfolio. During the period 1970 to 2008, for example, an equity portfolio of 80% US stocks and 20% international stocks had higher general and risk-adjusted returns than a 100% US stock portfolio. Specifically, international stocks outperformed the US in the years 1986 to 1988, 1993, 1999, 2002 to 2007, 2012, and 2017. Emerging markets and international small cap stocks have crushed the US market historically, for example, as they're considered riskier, and investors are compensated on average for that greater risk. And this is just talking about performance. The volatility and risk reduction benefits are another conversation entirely, which is of huge significance for a retiree. If I were making this video in 2010, or 1990, or 1980, we'd be talking about how a global portfolio beat a US portfolio the previous decade. The important takeaway is that it's impossible to know when the performance pendulum will swing and for how long, much less how those time periods would match up with your personal time horizon and retirement date. Ray Dalio and Bridgewater maintain that global diversification in equities is going to become increasingly important given the geopolitical climate, trade and capital dynamics, and differences in monetary policy. They suggest that it is now even less prudent to assume a preconceived bet that any single country will be the clear winner in terms of stock market returns. In short, geographic diversification in equities has huge potential upside and little downside for investors. Now let's talk about AUM and fees. Though both funds are highly liquid and extremely popular, VTI is much more popular with over $250 billion in assets under management. VT has about 1/10 of that at $23 billion. There are probably a couple reasons for this. First, VTI was launched much earlier in 2001, while VT launched in 2008. Secondly, as I said, many investors are using VTI and VXUS for a home country bias. Lastly, target date funds are doing the same and are using VTI and VXUS instead of VT. VT has an expense ratio of 0.08% or 8 basis points, compared to 0.03% for VTI. In conclusion, while they're both very popular, have low fees, and reliably track their respective indexes, Vanguard's VT and VTI are two completely different funds. The former is the entire global stock market, while the latter is just the US stock market. I'm a huge fan of diversification across geographies. In any case, don't use VTI alone. So the question becomes, do you want to be completely hands-off and use VT to get the market cap weights of the world? Or would you rather use VTI in conjunction with VXUS or your international fund of choice for some home country bias and rebalance regularly? What do you think of VT and VTI? Let me know in the comments. Thanks for watching.